7% in today's trade as we speak. Let's look at a preview for banks. It looks like the banking sector is set to have a steady quarter this time around with strong credit growth and stable asset quality. My colleague Harsh joins us with what to expect, especially with some of the big banks coming this weekend.
Let me start off with growth because some of those numbers have come out and the growth numbers look quite decent overall in every sense of the word. In fact, the growth numbers look strong for some of the larger private sector banks. Even some of the smaller banks have clocked in very, very strong credit growth trends. So that is the one key positive. But that has to be followed up with deposit growth as well, which has lagged. Now, we're giving you this 11% deposit growth number on average. But, of course, quarter-end trends are showing a very strong deposit growth. But when you're looking at average quarterly balances, deposit growth hasn't translated. And hasn't translated as fast as credit growth has. Let me put it that way. What this therefore does is your CD ratio will likely inch upwards, which is your credit to deposit ratio. And that is expected to inch towards the 83% mark as a result. This is system-wide. And therefore, deposit growth has to really catch up. Now, what does that do? Margins therefore come under a slight bit of strain because margins which are expected to recover as a result of the lower deposit rate cycle will not translate. Why is that so? Because there is a competition on the deposit side of things and therefore NIMs will largely remain flat. That's essentially the expectation. In terms of asset quality trends, they are expected to be stable. Of course, it's a risk. The fact that there is a war ongoing will obviously have an impact with regard to trends within microfinance, MSME and the like, and we'll watch out for commentary with regard to that. Now, in terms of commentary itself, what is it that we look out for? The PAT growth largely will be moderate at around 7%. That's what is currently being penciled in. Let's talk about commentary now. Credit versus deposit, how does growth really pick up? There's tighter liquidity currently, and some of those trends is what we'll catch on from the con calls. The second thing is the deposit competition that's evolving in the marketplace. We'll get a sense of that. What are the average quarterly balances with regard to the deposit base? We'll get a sense of that as well. The rising CD ratio, whether that is a risk to credit growth, we'll get a sense of that as well. That's all on the balance sheet side of things. The other piece is margins. And the most important piece, at least this quarter, is going to be treasury gains. You're going to have a muted kind of a treasury setup in terms of your other income, which will weigh down on earnings. In some banks, this can go as high as 30% of your bottom line. And therefore, a subdued treasury will likely mean that profit growth doesn't translate as well. So some of those risks would well play out in this quarter. The last one is with regard to what we're going to look out for. MSME stress is one. Higher cost of funds, whether that's the new normal, is the other, will just be some of the questions which will be posed. Deposit mobilization and what are the banks doing with regard to that? What are the trends there is also what we'll see. And the fourth piece is with regard to any stress on unsecured. That may well be taken negatively by the market. Those are some of the top picks coming in from Motilal Oswal. But broadly, that's the setup with regard to the Q4 earnings for banks.
Thank you, Harsh, for that. Of course, this is going to be a muted earnings for many of the banks and financials this quarter, Q4 numbers. But we are stepping into the break and we'll be back with Mid Cap Masala.